medium students. Today also we are going to have certain lesson. Uh, last time, uh, last time we learned actually accounting concepts, right? Entity concept. We said like this. Entity concept has this type of mechanism, which is the person is there and the uh, business is there. Those are two separated things, right? Even though there is an interconnection, but you have to think that the owner and the business is owner and the business are separated, right? That is not the uh, legal entity concept. I told you legal entity concept says the companies and other government institutions have the legal right, which is in front of the law. The company, the firm, the business may be interpreted as a separate person, but this is not the case. Irrespective of the government or whatever business, the legal entity, irrespective of the legal entity or not, you have to consider the business and the owner are separated, right? Then we will have certain transactions here, and we will check or we will identify how to record those transactions. First of all, I will come with the practical scenarios, not like imaginary situations. This this person has a pocket. I told you that they also. It has, let's say, 1,000 rupees. It has 1,000 rupees. This is from any from whatever activity he had before, right? 1,000 rupees he has gained, right? Then out of this 1,000 rupees, you are starting a business now. You are going to start a business now. Out of this 1,000 rupees, you are spending, let's say, 500 rupees for your reload. Reload in order to start the business. Start the business in the sense, in order to start the business by, let's say, by advertising in Facebook or wherever you are advertising now. You are going to advertise now, right? 500 rupees reload. Then another 500 in the pocket you have. Then let's say another 100 rupees you spend for books, right? Books, because I told you now owner is there, the business is there, owner is separated from the business. We are keeping the records and all inside the business, right? For us to record inside the business transactions, you need to have certain books. Certain books in today's context, sometimes it may be a phone or whatever, the computer or whatever. In the computer you are recording the transactions, but let's say in traditional way, you have certain books in this exercises book, right? Exercise book. It may be a ruled one or with the columns and all, right? Okay, 100 rupees you spend for that. Now you have started the business. 500 reload and 100 rupees, then altogether 600. But the money went out from your pocket, but still 400 rupees in your pocket. That is not relevant to the business yet, right? Then 500 reload. What you will do is, based on this book, you will roll the book. You will roll the book. You will roll a cash book. Cash book. This is cash, right? Then you will have the date, description, and the references, and this is debit side. I told you last time. With this concept, you will have the accounting equation, that is that is the assets equals liabilities. Asset equal liability. Assets equal liabilities, right? What are these assets and what are these liabilities? We are going to have certain idea about the definitions today, right? What do you mean by assets and what do you mean by liabilities, right? Okay, you will have cash book. Let's say you have ruled now. You know you have certain sense on accounting now, right? Just assume that you may not have, because we are starting the lessons yet, right? Cash book, so called. Since this is A-level class, I assume that you have certain idea about these cash books and all in O-level stream, O-level section. But if somebody has no such kind of experience, just comment on that. We will explain all those things. Okay, cash book, and this is asset part, right? Asset part. At the liability side, you will have certain uh, any other account, T account or whatever, right? What are these assets? Assets are actually the resources. Resources which gained for the benefit of the business. Resources. Then what is liability? Liability is the obligation that you have to give that money in some day or whatever, recently or after some time, right? A liability is the obligation you have to recover, to give again that money, to return that money to whom the resources have been invested in the business. The person who is the owner of the business is putting some resources to the business. The business has an liability to pay that resources, whatever received from the owner. The obligation, the entity has that obligation to return that resources. That is two parts, right? Two parts in the sense we are looking at from the point of the business, from the point of the business. That is why in the business, inside the business, you have all these assets and liabilities, right? The asset is the cash. Out of this owner's pocket, you spend 500, you got some 500 money. The owner is the person who is spending the money. But remember that owner also should be considered as an outsider. That is the concept of accounting entity, right? Owner is taking some 500 rupees and giving it for a reload. Then that reload is for the business purposes. Business will generate some income in future out of that 500 rupees paid by the owner. Then business has the liability to pay that 500 rupees again to that owner. Then 500 rupees you will receive from this particular person, the owner, so-called owner. You will receive 500 rupees to the business. Then I will record that one first. Then cash book, whatever, let's say 7/24, cash received 500. Let's say this is cash, right? This is cash. This is debit side and this is credit side. What do you mean by debit and credit? For the time being, you keep it in mind. Assets, debit, liabilities, credit. Debit in the sense you will receive something. You have some resources then. right? You will have something inside the business. Liability in the sense you have to pay the obligation. You will have to pay something to outsider in future, in near future, in the in some within some period, right? Then cash received by the entity, then asset increased, the liability, the capital, share not share, actually capital. Capital is a liability. Capital in the sense the owner's input into the business. Owner's input, not the outsider's input. Owners are putting some money inside the business. Then this is also debit and this is also credit. Debit and credit, debit and credit. Everything has certain, everything has two basic steps or two basic parts, right? Debit and credit. Then you debited here the cash debit and the capital credit because you have that obligation 500, right? Then you will change the names of the accounts, right? Then you will write here cash, you will write here capital, because you need to identify from where it has come, right? Merely by looking at this, you can identify, okay, capital account credit. If this is debit, then whatever should be there in credit side, or else debit side, whatever minus. Debit and credit, whatever minus. Always the equation equals, right? It's like I told you, it's like scale. Every time this equals, right? Then capital 500,000 debit, 500 rupees debit, and cash debit. That is the initial getting 500 rupees from the pocket, not giving to the dialogue go wherever, right? Because you are starting now the business. That is the initial recording of business. This out of this 1,000, you are getting 500 and 100 rupees. Still 400 you don't need to consider because that is not the business. That is your personal 400 inside the pocket. You didn't touch for that as far as the individual unit concept business is concerned, right? Then preload, you are paying 500 rupees for the dialogue go wherever. Then the cash credit, cash went out from your, not the pocket now. This is inside the locker. Business has a locker, let's say, assume in a locker, not the pocket or whatever. Pocket you have individually. Business has the inside locker. Even if you don't have physical locker or whatever, you just assume that you have that locker, right? Then that locker is that locker is this. This is the cash book. That is the locker. Inside and outside, then input and output. This is input, this is output, right? Then okay, 500 in from the owners, again 500 went out for dialogue. Then that transaction also will be recorded like this. 500, let's say communication or telephone, let's say telephone no communication, 500 credit. Telephone account or communication account debit, 500. We will change the names and all. Here cash and here telephone, right? Okay, same day, let's say July 1st, right? Okay, then the initial 500 you recorded. Again you got 100 rupees out from your pocket. and spend for some books, right? Then that also you will record as a initial capital pumping, right? Then same day capital 100, then again cash 100, then out of that 100 you will pay for books, right? Then again you are paying for books. Stationery 500, sorry, 100. Then new expense will come, stationery 100. You will change the names and all here. Cash in cash book you mentioned it as stationery. Here in stationery account you will mention it as cash, right? All these are expenses. What do you mean by expenses? Expenses are the money outflow, money or whatever the resources outflow in order to generate the income. In order to generate the income. What do you mean by income? We don't have at the moment we don't have any revenue generation, but these expenses are being incurred in order to generate the income, right? Okay, telephone and stationery. Let's say this is this we are still in July month, July 1st, right? Revenue in the sense revenue in the sense whatever income you are receiving out of ordinary activities of the business. Ordinary activities, let's say out of this process, by using this process you are going to have certain ordinary activity, let's say vehicle buying and selling, that is the ordinary activity of the business, or whatever vehicle or whatever stuff you are going to buy and sell, advertising Facebook or wherever, right? Advertising Facebook or wherever. Okay, then these are the practical scenarios. Actually I'm teaching you how you start the business, not like the capital pump into the business. Those are not practical. Actually in practical scenarios you will have to take the money out of from you will have to take money from your pocket, and you will spend for each and every places. Then that has to be recorded. Those are recorded correctly. That is the recording, and then only you will have the whole entire control of the business from beginning to end, right? Then capital pumping we recorded, and expenses also we recorded. Okay, now here by using this money pumped by the owner, we spend to certain scenarios, right? Then expenditure comes from this, to the scene. Then revenue we'll see in later on, right? Okay, now you are advertising in Facebook or wherever, and stationery you got in order to record these transactions, right? Out of this 400 you spend 200 for lunch. 200 for lunch out of this 400, because now you had 1000 rupees, you spend 500 and 100, and the rest is 400. Out of this 400 you spend 200 for lunch. Then what do you mean by this lunch? if that is relevant to the business, you will take that also to the business. How? But remember, even if you start this business or not, you have to take the lunch, right? You are spending that 200 rupees for lunch. Then this is actually a personal transaction of that personal transaction of the owner. Therefore, you should not take these two accounts, and you should not take this expense the uh, to the business and say, okay, my meal expense is so much, right? If you are recording it as an expense, then this 400, this 200 also again you have to take as capital receiving. First you record that one, and later on you record it the expense. Record the expense. That is the system you have to follow, right? Okay. By advertising this Facebook, you are receiving then the first offer, right? Somebody made an offer, right? Okay, let's say you are selling something on Facebook, as I took that day as the example. Okay, we are doing certain classes, right? Online classes or physical classes. We advertised in Facebook, advertisement made in Facebook, that we are handling classes. Okay, then somebody is referring us now. Class fees is per month 2000, per month 2000. At the beginning of the month, that person has to pay the money. That person has to pay the money. Then now you are generating the income. The first income generation you will have this 2000 rupees, the class fees. Again, 1000 rupees paid, 1000 rupees will be paid later on, right? Then what will happen? 1000 rupees you got as cash. Then cash received 5th July 24, let's say. Class fees 1000 rupees. Class fees 1000 rupees, right? Then this one 1000 rupees. Then what is the account next side? What is the account next side? The revenue account, class fees. Class fees, credit 1000. You will change the names of the accounts, cashier. Why this credit class fees? It's an income. It's an income, right? Income in the sense, by using that owner's money, you are spending, you are doing some business now. That money incurred by the owner, this entity, the particular class, has to pay that money invested by the owner someday as a return. Then this class fees belongs to that particular person who invested to the business. This entire 1000 belongs to that particular person. That's why we mentioned it as credit, but we didn't put it in the capital account, because capital account is that this 1000 rupees, this particular person who invested money into the classroom doesn't expect this money quickly, right? He will say, okay, you keep it as it is and do certain expenses on that, and rest you pay me, right? Immediately he is not expecting this money to be returned by the entity to that particular owner. That's why he allows us to keep that 1000 rupees in separate account called class fees. It's also a liability account, actually liability in the sense, that 1,000 received, you have to pay, right? You have to pay immediately or someday you have to pay. That's why it is credit. Capital pump also credit, this revenue also credit, right? Okay. Then what is the position of next 1,000 rupees? Because that particular person has to pay 2,000. Particular person should pay 2,000, but out of 2,000, 1,000 you received, another 1,000 you have to be received. That also you can record now. That also you can record now. It's actually a receivable thing. It's actually a receivable thing. Like you may have heard the sales journal, right? This now in accounting you will have certain steps to be followed, right? First of all, transactions should be recorded in journals, source documents, right? Source documents. But in at the initial stage of this business, we took only the book, ledger book, right? Otherwise, you have to buy certain source document books as well, receipts and payment vouchers. Receipts and payment vouchers also you have to get ready. That is the complete process, right? Still we didn't pay for that. Okay, just assume that out of this 100 for stationery, you have ledger books and source document books, right? Source document books. For each and every transaction, the transaction initially starts from source document. Remember that. For this capital pumping, the source document is, you have to put certain source document here, receipt. 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 That is the debit receiving of this cash book, right? Capital pumping, you will record this as owner invested some blah 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 500 rupees. Then date 1/7/24, likewise the amount is 500. Then you put a receipt here. Based on that receipt, you have to record it in the journal. The cash book is a journal. Cash book is a journal and also a T account. You may have learned that, right? Journal. Then we will record the second step is recording in the journal. Then we will record it in the journal. That is this cash book represents a T account and also a journal, right? Then capital, the cash debit and the other in the ledger book, the ledger book credit, right? Then second 100 also like that, you will put a receipt here and receipt number will be appearing here inside on the receipt number in the reference column, and 100 and the capital account credit. Okay. Then you spend money for telephone charges, the source document, the initially you have to record it in a source document. The source document is payment voucher. Payment voucher, in that payment voucher 500 you spend for dialogue. Likewise you will write down the payment voucher. The payment voucher number will be appearing here. This number, particular serial order should be there. The telephone charges paid 500. You will record it in the source document and journal, right? All these source documents you will file in a separate file, separate receipt file and separate voucher file, right? Separate voucher file and separate receipt file. Okay, the stationery 100 purchasing also you will record. You will put the voucher here and 100 rupees and date and the serial order of the voucher. you will write the description, pay in for books, right? Then this payment voucher is the second voucher. First one, second one, serial order must be there, right? It will be recorded, it will be filed in separate file, payment voucher file, and you will update the journal also. Journal, cash book credit, and the stationery debit, right? The second thing also we noted, this 1,000 rupees you will receive from uh, debtors, you will receive from the person who is coming for the class. Then that is also, you will put a receipt and you will give some copy of that receipt to the student, right? Then this receipt, source document is receipt. Then secondly, you will record it in the journal, saying 1,000 rupees received from class fees from this to this. Likewise, in that also you can mention the balance part also, another 1,000 to be received likewise. Okay. You put the receipt and you record it in the journal and the T account, right? Then another 1,000 rupees he didn't pay. Another 1,000 rupees he didn't pay, but you have to record it. You have to record it. How do you record? This initial cash generation is actually a turnover kind of thing. Turnover in the sense, it will turn out. Turnover in the sense revenue, right? For revenue, you can use the receipt method and also the invoice method as well. Remember that. What do you mean by invoice? Invoice is the amount received or receivable from the person for the purpose of general business activity. General, what is the general business activity here? We are conducting classes, right? That is a general business activity. For that general business activity, we are raising an invoice. Here receipt, here vouchers. The third source document you will have invoice, right? The cash receiving from the people, from the students, you can record it as receipts and also as invoice, right? Let's assume that you have recorded it as invoice. Then invoice, it will say entire 2,000 rupees. Entire 2,000 rupees it will say, but money received 1,000 it will say. Another balance 1,000 it will say, right? Then what you can do is, this entire 2,000 rupees for that particular period, no, let's say for the month of July. For the month of July, your entire revenue is 2,000 rupees. 2,000 rupees. That can be recorded initially in a journal called sales journal. Sales journal. Because for this 2,000 rupees, still you have received the money only 1,000 rupees. Another 1,000 to be received. Therefore, the debtor should be debtor. The another 1,000 is the debtor. That money you have to receive. You will receive that money in future, right? That debtor should be recorded in a proper manner, right? So therefore, we will record this entire invoice value in sales journal, class fees, July. It's a kind of a CR book or whatever, separate book, a journal kind of thing, right? 2,000 rupees, right? Okay, 2,000 rupees. We will record it in a class fees account. 1,000, the entire 2,000 rupees we recorded in class fees account, and out of 2000 you have received only 100,000. Then class fees account credit, and the debtor account debit 2000. Class fees. You can record that way as well. Entire you got for the sales journal 2000, and the entire 2000 you recorded as revenue, class fees revenue, and the debtor debit entire you recorded initially as debtor debit, but that particular person paid 1000 rupees for that month's half, right? Then for that 1000 rupees, then this invoice creation may be done by a separate worker, right? He prepared the invoice and gave. That particular person went with that invoice to the counter. That should be the controlling, internal controlling you have to design in your business, right? Two separate persons may be there, or else if it is a particular one person, then that particular one person should record those things separately: invoice creation and money receiving, right? So based on this invoice, you will pay 1000 rupees. Then for that invoice you will put separate receipt for that 1000, and that will be recorded here, and credit debtor credit 1000. Out of this 2000 you have paid now 1000 rupees cash. Then the balance will come here. Balance is 1000 brought forward and carry forward, right? Balance will come here. Then those are the transactions that you have to consider at the initial stage of the business, right? We recorded the money pumped in by the owner, and we spend certain money. We spend certain money for the revenue generation, and we recorded the revenue as well. Okay. Then what will happen? Now what are the transactions in sketch, in summary? What are the transactions you had? Money pumped, $600, right? Then spent for stationery 100. Then class fees, the revenue is the money receiving or receivable out of ordinary course of the business. Ordinary course of the business is conducting classes, right? Revenue, money 1000, right? Money received 1000, balance 1000. Those are the transactions we recorded now, right? Then money pumped 600, that recorded in the cash book as well as the capital account. Spent 100, and not 100, another expenditure 500. 100 then 500. Reload. Right? 100 then 500. Right? Then revenue 2000 and money received 1000, and the balance is 1000, that is debtor. Debtor is the money that you need, that you will receive in future, right? Okay. Now out of these transactions, what is the recurring revenue nature and what is long-term nature. Now, let's say money pumped is a long-term, right? Spent for 100 and 500 for the current period, for the month of July, because this reload and all you can't pay for the years and next, right? It's for a shorter period. The expenditure is a revenue nature, revenue expenditure. In order to generate that revenue, what is the revenue you have generated? This one, revenue. This one you have to pay to the owners, but after you have to pay to the owners. Right? This is the revenue, and this expenditure is in order to generate that revenue, right? Money received and the balance. Money received and the balance is also not the revenue nature, but for long term, let's say long term or short term, it's assets and liabilities. Assets. Because we considered entire 2000 here, no? Again, we don't need to consider the money received and all. 1000 and 1000, 2000. That is the total revenue we considered here, right? Then the short-term period, the revenue, you remember, no, we learned matching concept, right? According to the matching concept, what it says was matching. First, you assess the revenue. Revenue is the money received or receivable from the ordinary course of business. What is the ordinary course of business? Is the doing classes, right? Matching concept. First, you assess the revenue and match, deduct the expenditure in order to gain that revenue. Expenditure, deduct expenditure. Then it will come profit and loss. Okay. Now we are going to calculate the profit and loss. Revenue is 2000. Expenditure. What are the expenditure? Reload 100 and stationery 100. All these expenses are not incurred for the loan period after 1 year, like not for the loan period but for the current period. That is, it means you can match accordingly. Otherwise you can't match. For example, if you have taken, let's say, projector or table or whatever as expense, that is for revenue generation, but it will go for many years, right? It will go for many years. Then you can't deduct entire thing from that particular revenue. You have to proportionate it and deduct. Okay. Then those are the expenditure you spend, right? In 600 rupees. Then 1400 rupees is the profit. It belongs to the owners. it belongs to the owners. That means profit and loss account. Profit and loss account rest, you can hit to this particular capital account as well. We will keep it as it is in the profit and loss account, brought forward account, because we have certain things to be done in future out of these profit and loss accounts, right? So that is the starting point of transaction, starting point of the business, and we calculate the profit also. And what will be the balance sheet then? The balance sheet will say like this. Balance sheet asset some date, right? Assets. What are the assets we have now? Cash book we will close down now. We will calculate the balance now. Cash book. Then the money received by you, 600, then 1000, 1600. You get here 1600. Then the expenditure you spent 600, then 1000 cash should be there, brought carry forward and brought forward 1000 cash. You have 1000 cash here, 1000 cash here. What is the debtors status? Debtors 1000 balance is there, because out of this class fees 2000 rupees, only 1000 you received. Then debtor 1000. Okay, no other assets or whatever, right? Then 2000 rupees, right? Then liabilities, you have that capital account, balance that capital account 600, then 600 balance, 600 balance, right? What is the profit and loss account balance? That means revenue minus expenditure. It comes from the profit and loss account. Revenue generation and the income related to that profit and loss account. Revenue from the sales journal, the balance, you will tally the sales journal, and total you will count the total, and revenue is 2000. What is the expenditure? You will close down these accounts. Telephone account 500, brought carry forward, then brought forward 500. You will transfer from this particular expenditure account directly. You can transfer to the profit and loss account. Profit and loss account. Assets and liabilities, you will get the carry forward and brought forward balance. The expenditure and revenue accounts you will have to close down. No any other balance or whatever in the future, because I will show you how it happens. The telephone account 500 TP, and stationery account also you will close down 100 stationery. All those are the two main expenditures, 600 rupees. Then what will be the profit? 1400. The profit. Here what has happened is the this total sales journal total 2000 you recorded it as class fees, right? This is revenue account. This is current period, this is also current period, this is also current period. In order to generate that class fees, you incurred these two expenses. These all these three revenue and expenditure net is 1400. That means the small fishes will be eaten by the big fish. Big fish. All these small t little fish, right? These little fish will be eaten by big fish, and ultimately it will give the result profit and loss account. Then that will get to the balance sheet, profit and loss 1400. Then balance sheet will be telling to 2000 rupees. That is the process of accounting. That is the process of recording transactions, right? Okay, we got this example from the beginning of the business. You will say practical from in practical scenarios, how do you record these transactions without saying, okay, let's say the capital invested this much. Likewise, not like that. In practical scenarios, you have to take money out of your pocket, and you have to spend from each and everywhere. And whatever money you not considered from your pocket, for example, your lunch expenses and all those are not related to the business. Related to the business only we considered here, not related to the business, like meal or whatever short eats you were eaten, you had during your leisure time and all, you didn't consider for the business transactions. The practical point of view, you started the business and recorded the transactions, few transactions you recorded, and calculated the revenue and expenditure profit and loss account. And the profit and loss, the small T accounts were eaten by the big fish, and ultimately he gave the big picture, and it hit to the balance sheet. Then this is the financial position of you at particular date. Let's say today you have this type of financial position, right? Your assets and liabilities. Your asset worth 2000 and your liability worth 2000. That means you have 2000 worth business now. You invested 500 rupees and 600 rupees. That is 500 rupees and 100 rupees, 600. After 1 month or after first transaction, your wealth increased to 2000. Your wealth increased 2000. This entire 600 and 1400 you can get again from the business, right? So that is the simple transaction recording of business, right? Okay, we will move gradually to harder questions, more and more harder questions, and more difficult questions, right? For the time being, we will stop here, and I hope you understood something. And if there is any problem, or if there is any clarifications, and if there is any area to be clarified by me for you on behalf of you, just comment on comment section, and we will meet again next day. Bye for now. If you couldn't see this bottom line, okay, just record it, pausing the video.